The clock read 2:37 a.m., and my trading account was hemorrhaging money like an open wound. I stared at my screen, a masterpiece of technical analysis that looked more like a war zone than a chart. Every line was perfect, every zone calculated with surgical precision. Yet somehow, the market kept finding ways to humiliate me. Stay with us. Like, subscribe, and turn on notifications. Your support helps us create and improve content. That's when the question hit me like a freight train. If I'm doing everything by the book, why am I still losing? The answer would shatter everything I thought I knew about trading. Those support and resistance lines I'd drawn so carefully, they weren't just price levels. They were psychological scars, emotional battlefields where millions of traders had bled before me. Let me show you what really happens when price touches those zones, and why understanding the human psychology behind every level is the difference between being the hunter and being the hunted. The truth about support and resistance. They told you to draw horizontal lines where price bounced. Clean, logical, simple. This is resistance, they said. This is support. And you believed them. You drew your lines where price touched once, twice, 3 times. You waited patiently. The market approached your level and either reversed perfectly or broke through, only to snap back and trigger your stop loss, again and again. But here's the truth no one tells you. That line you drew isn't magic. It's memory. It's trauma. It's the collective psychological scar tissue left by thousands of traders who bled at that exact level. Every zone tells a story. Imagine a battlefield. You weren't there when the first shot was fired, but the blood is still on the ground. When the market returns to that level, it doesn't see a line. It feels the echo. The echo of regret from traders who bought too high and are now trapped, desperately waiting to break even. The silent tension of those who missed the initial move and see this as their second chance. The hunger of profit takers who know exactly where weak hands will capitulate. Support and resistance isn't geography, it's psychology. It's a congregation point for unresolved emotions. And when price approaches these zones, you're not just watching price action. You're witnessing the ghosts of old positions awakening. The emotional architecture of every level. Here's what happens when price revisits a significant zone. Regret speaks first. It shows up as that nagging voice. I knew I should have sold there last time. I won't miss it again. So when price returns, that trader jumps in, not from conviction, but from unresolved guilt. And guilt is a terrible decision maker. Then comes greed. Greed doesn't look backward. It lunges forward. It screams, "This is your last chance to catch the move." It doesn't care about structure, confirmation, or risk management. It only cares about not being left behind. So it convinces people to enter just as smart money prepares to exit. Fear follows close behind. Fear of missing out. Fear of being wrong again. Fear of watching profits slip away. Fear makes traders act impulsively, entering too late or exiting too early. Think about it. How many times have you bought after telling yourself, I missed it last time, not again? That wasn't strategy talking. That was unresolved emotion making your trading decisions. The market makers know this. Professional traders and market makers understand the psychological architecture better than anyone. They don't just see price levels, they see emotional pressure points. They know exactly where retail traders are trapped, where stop losses are clustered, and where FOMO will drive the crowd to act irrationally. They design their moves around these psychological zones, using them as hunting grounds for weak hands. While you're drawing perfect technical lines, they're reading the emotional map of the market. The SNR code. Reading emotions, not just charts. The real SNR, support and resistance code, isn't about drawing better lines or finding more accurate zones. It's about understanding the invisible battlefield of human psychology that exists behind every price movement. When you start seeing zones as emotional pressure points, rather than just technical levels, everything changes. You stop reacting to fake-outs because you understand they're designed to trigger emotional responses. You recognize when the crowd is about to panic and position yourself accordingly. You can identify when smart money is manipulating price to hunt stops. You learn to trade with the market makers instead of against them. From prey to predator. Once you understand that every chart is really a psychological map, you stop being the victim of market manipulation and start becoming the beneficiary of crowd psychology. You learn to identify where emotional traders are trapped, recognize the signs of impending crowd panic, position yourself where smart money wants to go, not where retail thinks it should go. Use the crowd's emotional reactions as your trading signals. This isn't just a different way to analyze charts, it's a complete paradigm shift in how you approach the market. Because at the end of the day, you're not trading against algorithms or institutions. You're trading against human nature itself. And human nature, unlike market conditions, never changes. How many times have you stubbornly clung to a losing trade, whispering to yourself that maybe it'll bounce back to break even? This isn't strategy. It's memory hijacking your decision-making. Support and resistance aren't mere tools. They're historical monuments. They reveal where collective hope shattered, where the crowd's expectations crumbled. The deeper you dive into price action, the more profound your understanding becomes. You're not trading levels, you're trading emotional residue. But what unfolds when these psychological scars become fortified? What if behind every level stand not just emotions, but powerful, conflicting forces? Let's venture into this hidden battlefield and encounter the three armies lying in wait at every zone. Every zone you mark on your chart appears calm, neutral, seemingly safe. But don't be deceived. Beneath that tranquil surface simmers an intense standoff, a war between three distinct factions, each driven by unique desires, fears, and triggers. And when price approaches, the battle erupts. The first army consists of the trapped traders. These are the individuals who entered positions at the worst possible moments, buying too late or selling too early. They watch helplessly as the market moves against them, paralyzed by denial, now waiting and hoping, desperately praying. Each price tick closer to their entry point sends a surge of adrenaline through their veins, not as a path to profit, but as a potential escape route. They aren't dreaming of victory. They're yearning to minimize their losses. The moment price returns to their entry point, they pounce, closing their positions, and their collective exit creates pressure that stalls market momentum, like prisoners rushing through a momentarily open gate. The second army comprises the profit takers, disciplined traders, who anticipated the move before the masses even recognized its potential. Already deep in profitable territory, they've been strategically waiting for this precise moment. For them, this zone isn't an opportunity, but an extraction point. Like seasoned snipers calling for extraction after completing a mission, they execute with cold, calculated precision. When price reaches their level, they methodically offload their positions. Their selling isn't driven by panic, but by strict protocol. The third army represents the FOMO crowd, the watchers who missed the initial market move. They gaze intently at the screen, their eyes burning with envy and urgency. The prices return to the zone, and suddenly they see their moment, a chance for redemption, a second opportunity. Without hesitation, Without questioning safety, they plunge in. Buy orders flood the market, and hope surges through their hearts. But in their frenzied rush, they miss a critical detail. They're buying precisely where the smart money is exiting. The market becomes a battlefield where three armies converge: the trapped, the profit takers, and those driven by FOMO. When price arrives at a significant zone, each group responds differently. Sometimes the trapped panic faster than FOMO traders can buy, causing a violent price reversal. Other times, FOMO overwhelms the exits, blowing the top off the zone. Occasionally, profit takers drain momentum so efficiently that the market simply dies. The outcome isn't determined by technical lines or timeframes, but by the timing of emotion. Who acts first? Who hesitates? Who breaks? A trader's true skill lies not in predicting the winner, but in recognizing the alignment. When the trapped fall silent, profit takers complete their moves, and FOMO becomes rabid. That's when breakouts happen. When all three armies hesitate, it signals rejection. When they descend into chaos, it's a trap. Forget the lines. Study the armies. Feel the pressure within the zone, not just the candles. When you can clearly see the battlefield, you'll know precisely when to strike and when to disappear. Behind every battle lies a memory, a deeper pattern waiting to be understood. The novice sees opportunity on the chart. The professional sees a trap. The difference isn't knowledge, it's timing. And nowhere is this difference more brutal or more profitable than at the edge of a zone. This is where the sniper truly lives. The crowd prepares to storm the gates, but the sniper remains motionless when price first touches a critical level. They observe, they wait. No immediate entry. That's for the restless traders who need constant action to feel alive. The sniper isn't here for excitement. Their purpose is survival and victory. They recognize the initial contact with a zone as pure noise, a swirling mix of emotion, confusion, and misleading signals disguised in a single candle. Price might pierce through the level. It could bounce slightly. Perhaps it will attempt a false breakout. None of this matters. The sniper doesn't react. They understand that true entries emerge not from the level itself, but from price's behavior around it. So they wait for the decisive moment, a sign, a signal indicating one side is losing control. It might be a long rejection candle with a massive wick, perhaps a bearish engulfing pattern, maybe RSI divergence, or simply a subtle shift in candle body structure revealing the move's lack of conviction. That's the trigger. That's the signal. Only then do they act. No chasing, just precise placement. A clean entry, a logical stop loss, typically positioned just above the wick that flushed out the impatient traders. Then they vanish. No second guessing, no adjustments. The task is complete. If the trade succeeds, it succeeds. If it fails, they retreat with minimal damage. Emotional reactivity never causes them to bleed out. Most traders fight like sword-wielding warriors in a gunfight. Close combat, hacking wildly at the market, hoping sheer effort will bring victory. The sniper, one shot, one precise hit. The beauty is their visibility. Right after a false breakout, when price reverses with surgical precision and doesn't hesitate, you'll notice something. The sniper was already positioned, not through prediction, but through understanding the pattern of exhaustion. They don't need to be first. They just need to be right after the wrong. And that's what makes them deadly. A sense of tranquility settles over this approach, bringing with it an unshakable confidence and profound stillness. The sniper isn't hunting for action, but waiting for reaction. They observe, allowing others to reveal their intentions before making a calculated move. This strategy transforms the dynamic from pursuit to provocation, from reaction to strategic exploitation. But what happens if the sniper enters the zone with a clean break? No rejection, just a sudden, violent breakout. Is the opportunity already lost? Not at all. The market has another trick waiting. Breakouts burst like fireworks. A sudden surge, a long green candle slicing through resistance, or a sharp red one crashing through support. Chat rooms erupt, screens blaze. FOMO ignites like a spark in dry grass, and suddenly everyone wants in. But the strategic trader simply smiles and waits. Because true traders understand, the breakout isn't the real opportunity. The retest is. Imagine the breakout as a door being violently kicked open. The explosion is loud, the movement swift. Yet smart money doesn't chase the initial breach. Instead, they position themselves on the other side, prepared at the next critical decision point. Most breakouts are emotional, driven by FOMO and thin trading volume. Without substantial follow-through, they become traps. The market understands this psychology perfectly. It allows price to pierce through a level, baiting the impatient, then deliberately pulls back. That pullback is the moment of opportunity. A genuine retest isn't merely a return to an old zone. It's a psychological checkpoint, the market's way of testing conviction. If a previous resistance now becomes support, this is where it must prove its legitimacy. A level that holds demonstrates true belief. A level that fails reveals the breakout as a deception. Watch for a specific sequence. Price breaks through a level, then gracefully drifts back, not in panic, but with calculated precision. It taps the old resistance like a soldier, gently knocking on a familiar door. A pause. A moment of hesitation. The crowd holds its collective breath. And if the move is authentic, it launches again. That hesitation is pure gold. The precise moment when emotions reach their peak. The FOMO crowd stands paralyzed, caught between chasing and waiting. Bears trapped in their positions now doubt their initial assessment. The sniper, seasoned and calm, knows exactly what to analyze. They're looking beyond mere structure, seeking deeper symmetry. The retest must respect the previous level, perhaps grazing it slightly but never collapsing. It should decisively reject, transforming what was once a ceiling into a solid floor. This is the precise entry point. Clean, logical. The stop loss sits just beyond the zone, protected by rational calculation, not desperate hope. If it holds, you're positioned for the genuine move. This isn't driven by emotion, but by clear confirmation. The retest represents more than a price opportunity. It's a chance for personal reset, a moment to shift from urgent, reactive trading to structured, deliberate strategy. You transition from a market chaser to a signal listener. But a critical warning exists. Not every retest is genuine. Some are carefully engineered illusions, designed to seduce you moments before a devastating reversal. The breakout initially appears perfect. Candles align beautifully. Volume surges. Price decisively breaks through stubborn resistance. The crowd erupts in excitement. Buy orders flood the market, carrying a wave of collective belief. Yet beneath this apparent momentum, a colder, more calculated dynamic unfolds. Not all breakouts are created to continue. Some are meticulously crafted to deceive. The false breakout emerges, the market's most lethal maneuver. Its danger isn't in failing, but in succeeding just enough to draw you in before violently shutting down. It's a predatory trap disguised as opportunity, where market predators feast, while novice traders watch the breakout candle and impulsively buy with trembling anticipation. Experienced traders observe differently. They analyze entry dynamics, speed, volume, Participant behavior. They understand that a breakout appearing too perfect, too smooth, too obvious is often sophisticated bait, waiting to ensnare the unsuspecting. Market makers hunt stops with the same ruthless precision as a cat chasing a laser pointer. The false breakout is a psychological trap, weaponizing hope and speed. Price pushes past a key level just enough to trigger breakout traders and hits stop losses of short positions. It completely flushes out traders. And right when the breakout seems like it will continue, it suddenly turns, violently trapping long positions, triggering panic, and feeding on the resulting liquidation. But this isn't chaos. It's calculated choreography. You thought your stop loss was safe, carefully placed behind a support level, positioned logically just below the previous low or just above resistance. Disciplined, measured. But then it happens again. That uncanny moment where price spikes just enough to take you out, only to reverse instantly in your original direction. It feels personal, cruel, designed. Because it is. This isn't coincidence. This is strategy. The ones executing it aren't psychic. They're predators. Market makers, large players, smart money. Whatever name you use, they operate on one fundamental principle. Liquidity is life. And your stop loss? That's their meal. Stop losses aren't invisible. They're clustered and predictable. You've been taught to place them safely beyond obvious levels. But that's precisely the problem. They're obvious, which means they become magnets, targets, coordinates on a map that big players can see as clearly as you see your moving average. So, what do? They engineer price action to reach those zones. A fake push, a sudden spike, a candle that breaches the level just enough to trigger your exit. Your stop-loss market order floods the books, giving them the liquidity they need to enter on the opposite side. It's not random, it's extraction. Consider this scenario. A large player wants to build a long position, but they can't simply click and buy. Their size would move the market, resulting in terrible fills. So where are those sell orders sitting below support? Right where your stop losses live. They push price down fast and hard, generating fear, triggering stops. Your position gets closed automatically, selling into their hidden limit buys. The market's anatomy reveals itself through a simple trap mechanism. Expectation builds as price approaches a zone gradually, baiting trader attention. Emotional commitment is triggered, with price set to break out or break down. Traders are lured in, stops are flushed through a violent wick that pierces the expected level, then reverses. Exit liquidity secured. I recall the day I caught a stop hunt in real time. Price approached support and plummeted with a massive red candle. It wicked below the obvious level by 15 pips, then snapped back up instantly. The entire sequence lasted less than a minute. But I was prepared. My buy order sat precisely where I knew stops would trigger. That trade ran 200 pips, not because of any special skill, but because I shifted from thinking like prey to thinking like a hunter. Most traders treat breakouts as invitations. The wolf sees them as traps to disarm. Every false breakout creates an opportunity by generating imbalance, panic, and a trading vacuum. How many times have you jumped on a breakout only to be slammed the next candle? How often did it feel like the market waited specifically for you? Perhaps it wasn't waiting. Perhaps it was deliberately constructed. You're not a victim of bad luck. You're a victim of predictable behavior. The moment you become unpredictable, calculated, calm, and surgical, you flip the script. You stop being prey. You start playing the wolf's game. What if you could verify the wolf's presence? What if you could hear the market's true voice beyond its deception? The next revelation lies in the most underutilized truth teller in trading, one that never lies, always speaks if you know how to listen. Price can fabricate illusions, it fakes breakouts, teases patterns, but volume always tells the truth. It's the whisper beneath the noise, the pulse behind each candle. Volume doesn't show where price is. It reveals why price moved and hints at what comes next. Most traders treat volume like background noise, barely registering its presence. They fixate on candlestick patterns and support resistance levels, believing that's where market insights hide. But the true narrative lies in the weight behind each movement. Volume represents conviction, and conviction separates a mere whisper from a thunderous declaration. Imagine this scenario. Price breaks above a resistance zone. The candle surges upward. Your breakout setup screams go. But when you examine the volume, it's paper thin, weak, like a lone voice echoing in an empty canyon. This isn't breakout energy. It's desperation. The market attempting to move without genuine support. The inevitable result? Reversal. Collapse. A graveyard of premature, ill-conceived trades. Now reverse the scenario. A critical level is tested. Price hesitates momentarily. Then suddenly, boom! A candle erupts, slicing through resistance with volume like rolling thunder. This isn't coincidence. This represents genuine market participation. Institutional money pushing with clear, deliberate purpose. And that's precisely the moment to follow. Not the candle itself, but the conviction driving it. Volume provides traders X-ray vision into market dynamics. A candle might appear powerful, but with low volume, it's fundamentally hollow. A reversal might seem uncertain, yet if accompanied by a volume spike, it signals a battle decisively won by force. The key is learning to see beyond mere color and size. Challenge yourself. On your next trade, ignore price for half a minute. Simply observe volume. What narrative does it reveal? Low volume breakouts suggest artificiality, a scattered crowd without consensus, likely to face rejection or retest. High volume rejections indicate genuine market defense, signaling that a particular level genuinely matters. A volume spike at a key level followed by sudden silence might suggest a liquidity hunt, with a reversal potentially imminent. Gradual volume accumulation alongside price compression creates a pressure cooker scenario. Watch carefully for an impending explosion. Volume isn't confirmation, it's context. And context transforms everything. It doesn't just describe what happened, but reveals the belief system driving market movement. Yet exercise caution. Volume without structural integrity is mere noise. Always pair volume analysis with levels, price action, and broader market narrative. You're not simply watching bars rise and fall. You're deciphering market intention through participation. A trader might see a textbook pin bar at support and execute a trade, only to witness its failure. A stark reminder that volume tells a deeper story than any single visual pattern. Why? No volume means no belief. The market shaped him, but couldn't give him a soul. Without volume, that pin bar remained just a shadow, empty, lifeless. Another trader waits patiently. Price returns. This time, the same pin bar appears, but now accompanied by a volume climax. Suddenly, it's no longer just a shape. It's a powerful shout. He enters the trade. The market launches into motion. Same candle, but completely different energy. And that's the critical difference between blindly guessing and truly listening. Because ultimately, price speaks, but volume reveals the true message. Volume is the tone that exposes whether the speaker is bluffing, begging, or commanding. So listen carefully. Pay attention to the subtle nuances. But confluence alone isn't enough. Even when everything perfectly aligns, traders still confront their most dangerous enemy. And this enemy isn't found outside the chart. It resides within their own ingrained habits. Most traders desperately cling to a single signal, like a fragile life raft in a turbulent storm. A single line, a single pattern, a single rule. And that's precisely why they ultimately fail. The market doesn't reward simplistic approaches. It ruthlessly punishes predictability. There's a way to protect yourself, not by adding more indicators, but by creating overlapping logic, by establishing confluence. Confluence occurs when multiple undeniable truths converge at the same point. Not random guesses or emotional impulses, but concrete data pointing toward a singular zone, decision, and potential outcome. This isn't mystical. It's strategic alignment. And in trading, alignment represents pure power. Imagine a price level that initially seems ambiguous, but then layer additional confirmations. A rising trend line intersecting from below, a Fibonacci retracement precisely at 61.8%, a major moving average flattening across the identical area, a significant psychological number. Suddenly, this is no longer just a zone. It transforms into a fortress, a pressure point where multiple analytical perspectives unanimously agree. Something momentous is about to unfold. And that's when the market truly pays attention. Because the more reasons price has to react, the more market participants are watching, the more they agree. And market agreement is what generates movement, not indicators, but collective conviction. The critical caveat: confluence isn't about randomly stacking tools. It's about establishing correlated, interconnected logic. Focus on structure, momentum, and underlying market behavior. When price approaches a support zone and the RSI reveals divergence, volume contracts, and it touches a trend line, this isn't random noise. It's alignment, a moment of strategic opportunity. Imagine each analytical layer as a protective shield. Individually, they might crack under pressure, but together, they form an impenetrable defense. Confluence doesn't just increase probability, it provides profound context. It transforms a simple candlestick into something more complex, a convergence of collective market memory, structural tension, and behavioral dynamics. The beauty of confluence is its calming effect. When you trade based on alignment, you're not reacting impulsively, but responding to structural signals. Your stop loss becomes a calculated decision, not an emotional reaction. Your entry isn't a hopeful guess, but a measured approach. You stop fearing minor market fluctuations because you've constructed your trade like a meticulous architect, not a reckless gambler. Even seasoned traders respect confluence. They understand that zones with genuine alignment attract serious market participants. These professionals don't panic at every minor movement or get shaken by false signals. They defend their positions with the territorial instinct of a predator. When you identify true confluence, you're not just entering a trade, you're entering with a strategic support system. But be cautious. Confluence without clarity becomes meaningless complexity. Don't simply pile on indicators and mistake that for conviction. The critical question isn't how many tools you use, but how precisely they align. Are you witnessing a coincidental overlap or a true convergence? Are you responding to a single candle or synthesizing multiple evidence streams into one decisive action? In the market's chaotic landscape, clarity determines victory. The psychological pitfalls are treacherous. You might have a perfect setup, a level validated by historical performance, confluence stacked like protective armor, combining a sniper's patience with a predator's instinct, and still suffer losses, not because the market defeated you, but because you undermined yourself. These aren't market failures. They're psychological vulnerabilities that systematically drain trading accounts. Take vengeance trading, for instance. The market just stopped you out minutes ago, and now rage drives your next move. Price approaches a similar zone, and instead of objectively reassessing, you re-enter driven by spite. You convince yourself the market owes you, but this is a dangerous delusion. The market operates on probabilities, not personal vendettas. Making trading personal is a guaranteed path to failure. Trading from anger is like boxing while blindfolded. You strike nothing and get hit everywhere. The second mistake is entering a trade before the candle closes. You observe the rejection forming. The wick appears promising. Your cursor hovers over the buy button, but the candle hasn't completed its formation. You rush in prematurely, only to watch the candle flip and close against you. Why? Because you wanted to feel in control, not actually be in control. A candle tells a story. Let it finish its sentence. Confirmation doesn't diminish your edge. It protects you from chaos. The third error involves drawing support and resistance levels on a 1-minute chart. Micro trading weakens your signals, accelerates your decisions, and destabilizes your mind. You're reacting to noise, not structure. Zooming in too closely is like reading a single word and attempting to predict an entire novel's plot. Structure requires breathing room. Context needs time. Trade a heartbeat, not a heart monitor. Revenge trading resembles drunk texting an ex. It feels justified at 2 a.m., but morning brings only regret and margin calls. The fourth sin is placing stop losses where everyone can see them. Logical stops become predictable stops, and predictable means targetable. You believe you're being disciplined, but you're actually being visible. Market makers don't need to defeat you. They just need to know where you'll bleed. Protect your stop like a secret, not a standard. The fifth sin is believing this time will be different. You've lost at this level before. You ignored confirmation. You chased the breakout. You swore never to repeat those mistakes. Yet here you are, finger hovering, hope rising, telling yourself this trade will work. No logic, no change. Just a new trade layered atop old behavior. The market doesn't care about your intentions. Only your actions matter. These sins are subtle. They don't feel dangerous, but they accumulate, stacking like small leaks beneath a boat, unseen until you're underwater. Worse, they masquerade as trading, keeping your heart racing, keeping you busy. But motion isn't mastery. Action isn't advancement. Busy is nothing more than an expensive illusion in the trading world. The solution isn't about accumulating more knowledge. You already know what needs to be done. The real solution is self-command. The winning trader isn't the one with the most information, but the one who makes fewer mistakes. But what if there's another crucial element to this puzzle? Something that could help you construct an entirely new trading persona. We're about to dive deeper, not into charts and technical details, but into your inner landscape. We'll explore the subconscious patterns that drive you to chase, fear, and hesitate. Our goal is to rebuild the trader within, transforming your identity from a reckless gambler to a calculated strategist. Picture the moment every trader encounters. The charts are open. Signals are aligning. Your fingers twitch over the mouse. The setup isn't perfect, but it's close. Close enough to rationalize. Close enough to convince yourself. If I don't take this trade, you think, I might miss out. so you click. Not because the trade truly demands action, but because your inner restlessness compels you. And that's where the bleeding starts. The market doesn't reward activity, it rewards precision. But precision only emerges in stillness, in the space between signals, in those moments when average traders leap in and exceptional traders observe. Waiting isn't passive, it's profoundly active. It takes immense mental strength to remain still, to resist the urge to click. Why? Because doing nothing forces you to confront your deepest weakness, your addiction to constant motion. In trading, movement feels like progress. Entering trades seems like effort. But the truth is brutal. Every unnecessary trade is an assault on your patience, and the market collects its toll without mercy. Professional traders spend most of their time waiting, scanning, watching. They don't force opportunities, they recognize them. They understand that the market isn't a machine to be conquered, but a rhythm to be understood. If the market's song isn't right, they sit in silence. They've internalized a fundamental truth: money is made in the waiting. The sniper doesn't fire because they're ready, they fire because the target is perfect. Until then, the scopes remain motionless, sharp, and disconnected. Consider this carefully. How many trades have you executed simply to feel like you're accomplishing something? How many entries emerged from restlessness, the fear of missing an opportunity, or the pressure to make something happen during the day? And how many of those trades left you with anything other than disappointment? The price of impatience isn't just monetary loss. It's disrupting your rhythm, eroding your confidence, and training your mind to confuse mere activity with genuine skill. Even worse, it blurs your perception. When you're constantly in a trade, you're never truly observing the market. Instead, you're blindly reacting to it. Doing nothing when done intentionally represents mastery. It signifies that you have standards. It means your capital is preserved for moments of genuine clarity, not scattered noise. And clarity is the fundamental distinction between a gambler and a strategist. Here lies the paradox. The more comfortable you become with not trading, the more precisely you'll recognize the right trades. The less you pursue, the more the market unveils itself. Why? Because your ego isn't clouding your vision. You're no longer attempting to force profit. Instead, you're now inviting genuine alignment. Stillness carries an inherent elegance, a silent confidence. It communicates, I don't need this trade to validate my worth. And that detachment represents the ultimate form of competitive advantage. How do you cultivate this patience? By reframing your perspective. Stop asking yourself, did I trade today? Start asking, did I faithfully follow my process? Because process represents the only element truly within your control. Ironically, when you cease desperately needing to trade, you begin genuinely becoming a trader. The journey of understanding unfolds, revealing deeper insights with each moment of restraint and observation. He encounters this zone not twice, but 3 times. A former resistant area standing resilient under continuous pressure. Price approaches again, this time from above. With each contact, the reaction grows weaker. Candlestick wicks become shorter. Sellers appear exhausted. Yet he remains patient, not acting immediately. He simply marks the zone and steps back. Critical questions demand attention. What's the broader market context? Is the trend active or dormant? What time of day is it? How is volume behaving? Is this level genuinely significant or merely convenient? Over subsequent hours, price gradually moves toward the zone. Volume diminishes with no aggressive buyers or emotional spikes. Only quiet anticipation remains. The strategist recognizes this as potential energy, a pressure cooker on the verge of releasing. The first signal emerges. A wick penetrates the zone, probing just a few pips deep, enough to flush out early long positions. The candle closes back inside, trapping sellers. Liquidity has been cleared. He understands this isn't the entry point, but a revelation. The market is revealing its intentions. He watches for confirmation. The next candle forms a bullish engulfing pattern. Clean, full-bodied, with returning volume. This is the moment. He enters the trade, but not recklessly. His stop-loss is strategically placed just beyond the wick that flushed the crowd. Carefully calibrated, neither too tight nor too distant. Protected by rational analysis, not blind hope. His take profit isn't arbitrary. It's calculated based on the next significant resistance level, the next emotional memory on the market's map. He isn't hunting for an extraordinary win, but seeking high-probability market flow. Now he waits. Price initially moves slowly in his favor, then momentum gradually builds. A news event triggers a market spike, pushing price closer to his target. He remains composed. No greed-driven adjustments. No mid-trade interference. He breathes, observes, allowing the market narrative to unfold naturally. The target is reached, trade closed. No dramatic celebration. No excessive post-trade analysis. Just a methodical journal entry. Date. Setup. Rationale. Outcome. Lessons. The strategist doesn't evaluate trades purely by profit. His measure is alignment. Was the level legitimate? Did price behave predictably? Were market emotions comprehensible? A break-even trade can be successful if these criteria are met. A profitable trade might be a lesson if they aren't. Because mastery transcends being correct. It's about profound awareness. The strategist sees beyond mere candles and market zones. He perceives actors, roles, and scripts unfolding. He isn't simply reacting to market movements. He's interpreting a complex, dramatic performance. Yet even the most skilled strategist is ultimately constrained by his internal operating system. Every trade passes through a single lens, your mindset. When that lens becomes distorted by emotion, bias, or compulsive impulses, no amount of technical analysis can compensate. The journey ahead leads us deeper, not into charts and patterns, but into the core of your psychological landscape. We'll explore the subconscious mechanisms that drive you to chase, fear, and hesitate. Our goal is fundamental transformation, rebuilding the trader's identity, shifting from an impulsive gambler to a calculated strategist. No trader begins as a strategic professional. We all start as gamblers, chasing wins, fleeing losses, supplicating to luck, and desperately interpreting patterns we barely comprehend. We place trades not through methodical planning, but to satisfy an internal craving, to feel alive, to feel control. We label this process learning, but it's pure gambling. And the market sees through this facade immediately. The gambler exists in constant reaction. Green candles trigger fear of missing out. Red candles provoke terror. Their trades are emotional impulses masquerading as strategic decisions. They lack systematic approaches, operating instead through volatile emotional states, confidence after success, desperation following failure. Their trades are hope disguised in candlestick formations, fear camouflaged as risk management. In contrast, the strategist operates in deliberate response, not emotionless, but intentional. Their difference isn't robotic detachment, but a fundamental reprogramming of their most critical trading software, their mind. Every trading decision flows through one mechanism, the brain's reward system. an ancient primitive circuit designed for survival, not financial markets. This system doesn't care about technical setups. It craves dopamine. Each trade triggers a neurochemical spike similar to a gambler pulling a slot machine's lever. The anticipatory question becomes, will I win? Will I lose? Let's discover together. This creates addictive psychological loops, where the act of trading supersedes its actual outcome. Winning becomes secondary. Stimulation becomes the primary drive. This explains destructive behaviors, overtrading, revenge trading, repeatedly violating self-imposed rules. To transcend gambling psychology, you must fundamentally alter your emotional experience. This requires developing new neurological pathways and emotional response patterns. The strategist understands that dopamine isn't about the thrill of entry, but about the discipline of execution. They rewire their brain through deliberate practices, ritual, journaling, checklists, and affirmations. Their habits anchor their identity to calm, clarity, and control. They don't chase the euphoria of winning. Instead, they pursue the satisfaction of flawless execution. They train their mind to delay gratification, to embrace boredom, to find comfort in inaction. They know that in trading, stillness is power. When losses occur, they don't spiral into emotional chaos. They analyze objectively, recognizing that the market didn't betray them, they betrayed their own framework. Losses aren't failures, they're feedback. And feedback is how systems evolve. The rewiring begins with brutal self-awareness. They stop lying to themselves. They admit their patterns, their emotional tilts, their underlying neediness. They track these behaviors, label them, and interrupt their destructive cycles. Then they build new neural pathways. They reward non-trades that follow the rules. They celebrate exits that respected their stop-loss. They mark moments of discipline with more pride than moments of blind luck. Slowly, their brain rewires. Their identity transforms. They shift from being the trader who hopes and wishes to the trader who operates with absolute clarity. They become the professional who says, if this doesn't fit my plan, I don't touch it. This isn't just a mindset shift. It's a biological upgrade. The market doesn't care about desires. It pays those who earn alignment. And alignment with the market begins with alignment with oneself. The real secret is that even after rewiring the brain, mastering entries, and understanding price psychology, one final perspective is needed. A shift that reveals the market not as lines and candles, but as reflections of collective human memory. The journey continues, promising to unravel the deeper truths about support and resistance, revealing that traders aren't just trading levels, but the echoes of every trader who came before them. Support and resistance aren't about numbers on a chart. They're about human experience. These aren't rigid lines, but emotional landscapes etched into market memory. Thousands, sometimes millions of traders have left psychological imprints at specific price points. Moments of intense feeling like fear, hope, loss, and euphoria. These emotional scars don't simply disappear. They remain hidden beneath the surface, waiting silently for price to return and reawaken old sentiments. When price touches these zones, the market doesn't react mechanically, but psychologically. This represents a fundamentally different approach to understanding support and resistance. You're not just drawing technical levels, you're identifying emotional trigger points. You're not merely marking where price reversed, but where human traders were emotionally broken. Some levels persist for years because psychological trauma doesn't vanish. It lingers and fundamentally shapes behavior. And in trading, behavior directly influences price movement. Most traders make a critical error by treating support and resistance as static, obedient tools. They draw lines expecting automatic responses, but the market isn't a machine. It's a living reflection of human psychology, our patterns, mistakes, and instincts. Each time price approaches an old level, it's not a technical event. It's a psychological test. Who will hesitate? Who will remember past pain? Who will attempt to rectify previous mistakes? These psychological dynamics are what truly drive price movement. When you examine a chart, stop asking technical questions like, is this resistance? Instead, ask, who suffered here? Who remains trapped? Who's watching this level, ready to act from fear, greed, or desperation? By thinking in emotional terms, rather than positional ones, you stop reacting like the crowd and start anticipating its behavior. Support isn't just a price floor. It's a zone where enough traders collectively believe a floor exists. Resistance isn't simply a ceiling, but a memory of regret where traders wish they'd sold previously and now vow not to miss the opportunity again. This perspective transforms the chart from a technical object into a psychological map. Every level becomes a trigger, every market reaction a narrative, every price movement a human story. You're no longer trading setups, you're trading behavior, and behavior inherently repeats. That's your true competitive advantage. By understanding support and resistance through this emotional lens, you need no complex indicators, just clarity and psychological insight. And instead of predicting, you listen. What are the candles whispering? Who's getting nervous? Who's being baited? You let the story unfold. You become less active, but more accurate. You trade less, but win more. Because now, you're not fighting the market. You're flowing with the emotion that drives it. This is what separates the reactive from the strategic, the mechanical from the intuitive, the amateur from the master. And here's the final truth. You are never trading levels. You are trading the crowd's unresolved past. You are stepping into a shared hallucination and learning to see clearly through it. Now, as we close this masterclass, there's only one thing left to do. Seal everything you've learned into your identity. Because support and resistance is not just a tool, it's a language. And fluency in this language means freedom. Take a breath. Look back at everything you've just seen. Every candle we decoded, every trap we uncovered, every emotional battlefield we mapped out behind those simple horizontal lines. This wasn't a tutorial. It was a transformation. Because now, you no longer see support and resistance as static zones, but as living echoes of fear, of memory, of greed, of strategy. You no longer chase entries. You wait for stories to reveal themselves. You no longer rely on luck. You rely on awareness. You've shifted from drawing lines to reading emotions, from reacting to anticipating, from gambling to executing like a strategist. So here's what happens now. You close this video and open your charts. But this time, you won't be looking for setups. You'll be listening for psychological friction. You'll be scanning not for patterns, but for pain. Not for candles, but for confession. And you'll wait. Not because you're scared, but because you've evolved. Because you know that discipline is an entry, that silence is a position, that clarity is capital. That's what this channel's about. That's what this community's built on. So, if this masterclass shifted something in you, if it felt like we weren't just explaining a strategy, but revealing a new lens for how to see the market and yourself, then don't disappear into the next tab. Don't vanish back into the noise. Stay with us. Comment below which insight cracked you open, so we can build from there. And if you're serious about becoming the kind of trader who trades human nature, not just candles, then share this video with one trader you know is stuck in the old way of thinking, the gambler's way. Because this isn't just education, it's evolution. And evolution happens in tribe, in rhythm, in repetition. We'll go deeper into entries, into exits, into journaling, into how to build a trading identity so strong you stop hoping for edge and become one. Remember, you are never here to trade levels, you are here to master behavior, and it begins with what you don't do next. Let's continue the journey together. Don't forget to like, subscribe, and tell us in the comments how you're learning to care for yourself. Your words might inspire others.